Hi, everybody. This is Tim from Trading Strategy Guides. Hope everyone's had a great week so far. I know many of you are confused about how I manage my trades. I've covered it briefly in a few videos, but today I'm going to go into some detail. For me, the rules we're going to discuss are ironclad. I don't deviate from them. Discipline is important. Always wait for the proper signals to execute the rules. And when I say I don't deviate from them, I say I'm human, so I make mistakes, but my intent is to not deviate from the rules. Anyway, I'll get to all that shortly, but let's cover a few other things. First of all, can you guys hear me? Can you see my title slide here and hear my chat? I'll give you guys a chance to respond. As always, I've got my huge coffee right here beside me. But anyone who's been in a trading room with me already knows that. Oh, and by the way, tea is acceptable for you Brits out there. Hi, Agnaldo. Please forgive me if I don't pronounce your names right. Zoki Master, yes, correct. Thank you, thank you, thank you. Very cool. Oh, and you know, it says double your profit with proper trade management. You know, that's double. That's just kind of a number pulled out of the air. You could quadruple your profit if you manage your trade properly, or even way more. So, anyway, for those of you who are watching the recording of this live webinar, you can speed it up by clicking on the gear icon in the lower right and selecting a faster speed. Next, you'll be happy to know that the sun is shining and it's beautiful here in North Texas, so no worries about being interrupted by a thunderstorm, which has happened to us the last couple of weeks. So stick around to the end and I'll be sharing trading maxim number 40. Also, don't forget to click the subscribe button below and then click the bell so you get notifications of the new videos coming out. I do one webinar and two analysis videos every week. So, okay, let me talk about a couple of trades, actually 3 trades, trade setups that I've given you in the past. I'll link the videos below so you can see where I talked about them originally. But I want to give you updates. The first one is Halliburton. I mentioned this in a previous video that I'm short Halliburton around 26.94 on a break of this trading range. It popped up on small volume yesterday, so you see the volume is below average, and it was a pretty good pop up right there. So I'm going to lock this in down to move my stop loss down to 25.96 on my second half. Of course, first half is already closed, and we've got profit on that. But I'm going to lock in a buck or so on this first position. On the second position. I think there's more downside, but I just want to protect it, particularly since we got this pop yesterday. Next is Boeing. I've got to go back to my cursor to select Boeing. Okay, Boeing gap down a couple of days ago. You can see that gap down right here. Oh, that's annoying. You can see where it gapped down right here. And I think, I don't know, it has something to do with this nice $2 dividend, but because it happened right after this nice $2 dividend, but go figure. I don't know. Maybe they weren't happy with their $2 dividend. They wanted $4 or something. Who knows? Anyway, I moved my stop down on this to just below this low, so that if traders like to close gaps. Whenever you get a big gap like this, it's often closes. So if they come up to close this gap, I hope that I'll be able to survive a move like that, because often after a gap close, price will just go back in its original direction. Looks like it might be starting a little consolidation here, but that's left to be seen. I still think there's more downside to this. So I'm just I'm at I set my stop around 349.50ish. Okay, and the next one is Ripple. So we're going to strike the XRP trade from our watch list. It never triggered. It never popped down. I mean, it never closed down below this descending triangle. And now it's pushed hard on big volume. A huge volume, actually. I mean, this is 3 times, 4 times the volume average, maybe 5 times the volume average right here on this push up and close way above this triangle. So that totally negates our trade setup. It was a descending triangle. I was looking for a close below the triangle here, and a push down. It didn't happen. So this one is off the list now. Okay. So let's get on to the discussion of trade management. A lot of traders start out thinking that if I can get the right trade direction, then I can be a successful trader. Just give me the right trade direction and it'll go for $1 million. They spend a lot of time and cash looking for what has become known as the Holy Grail. But just like poor Arthur, in his legend, the Holy Grail was always just a little bit out of reach. Only a small percentage of these traders that look for this are actually become successful. And mostly those are the ones that stuck it out long enough to figure out that the Holy Grail was not about indicators or strategies, but was about the complete package of entry and trade management after the entry. In fact, the entry strategy is part of your trade management, but that's only a small part. I know people who can take a coin toss and using proper management could make money on a coin toss. So we talk a lot about entry strategies around here, and and that's because that's the sexy stuff, that's the new stuff. But the trade, how you manage the trade afterwards, is really where the profit comes in. So that's the boring, mundane things, but that's what we're going to talk about today. So try to stay awake. No, it's not that boring, and I'll make it go quickly. And if you miss something, don't. This will be recorded and posted on YouTube at some point right after the video is done. I mean, the live session is done. So you can go back and watch it if you need to. And also you can ask questions at the end. So I'm going to try to get through this and then open it up for questions, any kind of trading questions at the end, but this sort of thing. So anyway, the risk management is a huge part of trading. Not every trade will do what you want it to do. So you have to be prepared to take your losses. Okay. And we'll talk about how you can do that. Trade management is also about taking your loss when the time is right and the trade is not doing what you had planned. So at some point, you're going to determine that this trade is not going where you intended for it to go. And you're going to say, okay, well, I'm done with this. And this is where you have to put your big boy pants on and say, I'm taking this loss. It's not, my direction did not concur with the market, and the market is always right. So I'm out of here. Taking a small loss instead of holding it and saying, well, eventually it's going to come back around eventually. And yes, eventually it will come back around, no doubt about it. But do you really want to hold on to this trade that long? Because think about how many trades you might have won during that time with that money if you had gone ahead and taken a small loss when you had a small loss and you realized that your trade wasn't working. So I preach about that all the time, about your discipline and about sticking to your plans. So the other thing about trade management is taking profits. Some people will be in this trade and in it and in it and in it because it's moving in their direction. And then all of a sudden it will pop against them and stop them out, and they will not have taken any profit. So you want your plan to include taking profit at some point. Okay. But you don't want to take your profit too early. And you also want to allow your profit to run. So I'm going to talk about how you do that. Everybody says cut your losses and let your profits run. Well, that's good, and that's a good mantra to remember. But you need a plan that's going to get you there. And I'm gonna show you what I do. Okay. So bringing that around again. Trade management is allowing your trade to run when the market is going in your direction. Okay. So you're going to have to start understanding that the market breathes in and out, and I show you guys how I manage the trades that I take based on my analyses. And today was a good example when we talked about how one of the trades popped a little bit yesterday. So I pulled my stop down a little bit to protect my profits in case that thing does continue to push against me. Okay. But I also am leaving it room to turn and go back in my direction again. So, okay. So allowing your profit to run is also important. Having a plan. It's all about having a plan. If you have all of this stuff planned in advance, if you have allowed for all the possible contingencies, all the possible actions that price could take, and you say, okay, if it does this, I'm going to do this in reaction, and so on. That's going to help you, because in the heat of the battle, so to speak, it's hard to make decisions. But if you have planned for every possible contingency, then you don't have to think. All you have to do is just follow the rules. So your plan should be as comprehensive as you can make it. Now, obviously, you can't anticipate every single event in your life to plan. But in trading, there's only a few things that it could do. It could go up, it could go down, it could go sideways. You have to determine, well, how much are you going to allow it to go against you before you get out, and so on. And these rules can be fluid so that that you can react to the market, but they should be fairly fixed in that you know what to do without having to think about it too hard. And then the most important thing, in my opinion, is having the discipline and intestinal fortitude, which is just a fancy way to say guts, to follow your rules even when you don't want to. This happens to me so much. I see something and it's running away, but I have absolutely no signal to get into it, or no signal to get out of it, or take my profit, or whatever, and I just want to do it, but discipline says that I can't. And you guys, if you've been in a trading room with me before, I know people have looked at it and said, well, he's stupid to not be doing so and so or so and so with this trade. And I am saying, but it's against my rules to do that. It's not. And sometimes, the trade will turn and go the opposite direction, and I'll close it, and somebody will say, well, why didn't you just reverse your entry? Well, because reversing my entry is not part of my plan. I don't have a rule for reversing my entry. I will only take a trade when I get a signal. Now, I know there are strategies that reversing the trade is part of the strategy. And if I was using one of those strategies, I would do it in a heartbeat if that was my rule. But I don't currently use any strategies that involve reversing my entry if it goes the opposite direction. So I don't do that. And I don't get in the trade in the opposite direction unless I have the appropriate signal. Okay. So it's all about having your rules and then following the rules. Okay. If, like I say, if your rule includes reversing at some point, then do it. So today, what I'm going to talk about is how I manage my trades. My rules aren't engraved in stone. Many other successful traders have their own methods. But I know that new traders might not have any idea what's acceptable. I'm having trouble talking, and what may or may not work. So that's the reason why I'm going to share with you the way I do it. I want you to feel free to use what works for you, or modify what doesn't work, or just completely throw it out and come up with your own plan. Just make sure that your plan is tested and works for you. Trainers will always tell you that trading is very personal. I say it too, because it is very personal. It depends on a lot on your personal strengths and weaknesses, and and I'm free to tell you what I've identified are my strengths and weaknesses. And one of my big weaknesses is focus. I can't stare at 1-minute charts 24 hours a day. I will be off in Never Never Land in about 10 seconds if I were trying to stare at a chart and wait for it to set up. So I use automated tools, mechanical tools, timers, price alerts, all kinds of other stuff, so that when price gets where I want it to be, it screams at me and says, hey, 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 look at me, look at me. Okay. That way, if I'm watching cat videos, or I always say cat videos. I love cats, but I don't usually watch cat videos. But if I'm distracted by something else, I'm easily distracted by engineering things and and chart things, and all kinds of other things. If I'm distracted by something else, I want my computer, which what's the whole point of a computer? It's to help automate our lives, right? I set my computer up to scream at me when something is happening that I want, that I'm looking for, that I'm waiting for. So I know that's my weakness, and I have taken steps to alleviate that weakness as much as possible. Okay. So that's the reason why trading is personal. I know a guy, he's just phenomenal, and he can look at 1-minute charts all day long. He can sit there 12 hours and get into trades and make huge pips watching a dozen charts it's just pretty amazing to sit and watch them, except, I can only sit and watch them for 30 seconds and then I'm, checking my email. But anyway, I'm going to tell you today what works for me. But you're going to have to go through the journey of identifying your own personal issues and how to deal with them. All right. So be smart. I do these live webinars every Wednesday morning, and I try to leave time at the end to answer any trading related questions. So if you, as you do this journey, if you have questions, don't hesitate to, visit the webinars on Wednesday morning, ask questions at the end, post questions. I try not to be a slacker. I try to answer everyone's question that you post on the videos. I apologize if I get behind. I will catch up in due time. So don't give up on me. So with all that having been said, here's how I do things. My first trade management rule is I risk 2% of my trading account, no more than 2% on my trading account. That means that if the trade hits the stop, I will only lose 2% of my account. Okay. I think anything up to 3 or 4, maybe even 5% could be acceptable. But keep in mind that if you go through a long string of losses and you end up losing 50% of your account, which is reasonable if you've got a huge risk per trade, remember that you've got to make back 100% to get back where you were. So every time you take a loss, you have to make more back, a larger percentage of your account back to make up that loss. So keep your trade risk small. You might even want to start smaller, 1/4%, 0.5%. If you get sweaty palms and dry mouth when your position goes against you, definitely size your trade down. You should not have an emotional response to your trade going against you. Okay. I mean, that's part of maintaining your discipline, is to make sure that your emotions are in check. And I'm not talking about, I tell this story periodically. When I was a kid, and I'm about to date myself here, but when I was a kid, I was a huge Star Trek fan. The original series, yes. It came out when I was like 10. So I thought Mr. Spock was the greatest thing since sliced bread. And so I wanted to be Mr. Spock. And anyone who knows anything about Star Trek knows that Mr. Spock is a Vulcan and he has no emotions. So I practiced having no emotions when I was 10 years old. So I learned very early in my life how to control my outward emotions, control what other people see. So I thought, wow, they say discipline and emotional control is important in trading. Absolutely, but it's not like that. So I thought I would be great because I have this phenomenal control of my emotions. But no, it's totally different than that. And it involves sweaty palms and dry mouth when your position goes against you, and it shouldn't. So start off with a smaller size and gradually increase your size, and you'll, as you get wins and losses, you'll have better control over your emotions and you'll be able to size up your trade then. Okay. You can use a trade size calculator. When I'm trading Forex, I like the calculator at my FX book. So just to give you an idea of how that works, this is what it looks like right here. You just simply put your account size, in here. In this case, $10,000, 2% risk, and that's the percentage that I'm willing to risk. You can switch to actual dollar risk if you want to do that, but based on how I do it, I do this. Your stop loss, I'll tell you shortly how I calculate my stop loss, and then the currency pair that you're trading. And then down here, it tells you how many lots you're allowed to trade at that level. Okay. So that's all there is to it. I'll put a link to this position size calculator below the video so you can pick it up later on, but it is myfxbook.com. So that's how I do it. Okay. Here's how I calculate my stop loss. I use the average true range to calculate my stop loss. All right. I use 14-day ATR, and I use it for my targets and my stop losses. The ATR is a simple average of the length of each candle from high to low over the last 14 bars. So what it does is it measures the length of the candle in pips and adds up all the last 14 totals and then divides it by 14. So this represents the average volatility of the pair for the last couple of weeks on a daily chart, of course. The thing I like about using the ATR is it's self-adjusting. It allows for huge movers like the pound New Zealand and tiny movers like the Euro Swiss. Plus it allows for periodic market expansion and compression. Here's an example of the ATR. This is pound New Zealand. This happens to be TradingView. And this is the ATR. If you're back testing, you can line it up and put your line right here, and it will show you the ATR at that point. If you just remove the line or move your line over here, it'll show you the ATR at the current point, which is 138 pips in this case. So what that's saying is the last 14 bars are added together, which is, I don't know, somewhere in here somewhere, I guess. And it measures the length of this bar, adds it to the length of this bar, to the length of this bar, and so on until it gets a grand total and then divides it by 14. So this gives you an idea of the volatility. If you watch my analysis videos, you'll see that I like to look at the ATR to give me an idea when volatility on a pair or on a stock is dropping, because dropping volatility and dropping volume both are an indication of reduced interest in a particular move. So I talk about that more in my analysis videos, so you can watch some of those to see that. So to calculate stop loss on this particular 138 pip ATR, so my stop loss will be 1.5 times that, or 207 pips. So if I were going short on this and I entered right here, I would measure up. If I were selling this, I would measure up 207 pips, and that's where my stop loss would be. And we'll talk about targeting next. Okay. Well, let me show you this real quick. This would be how you would calculate the position size for this particular trade. Again, on a $10,000 account, 2% risk, 207 pips, pound New Zealand, which is the pair I was looking at. My trade size would be 0.147 lots. Okay. All right. My first take profit, my first target is 1 ATR. So in this case, my first take profit is is going to be 138 pips. Okay, simple as that. Now, the simplest way to follow these rules is by dividing my trade into two positions. As you know, I like to automate as much as possible. Now, I know that you could trade one position and at the target, you could, like I say, I like to take some profit, but let my trade run. So I'm going to take half off as soon as it hits the first target. You could close half your trade. Most trading platforms will allow you to close half your trade. But in my desire to automate as much as possible and keep from having to watch the charts, what I do is I actually divide the total risk into two positions. So in this case, I had 14 micro lots, or 0.147 lots, which I'll divide into two 7 micro lot positions. So I'll buy or sell both of these 7 micro lot positions simultaneously. Okay, so now I will have entered two trades on this particular pair. On both of the positions, I will put a hard stop loss, and that stop loss in this case would be at 207 pips. So two positions now, and in the example I used, I was going to sell two positions, so I will have a stop loss on both of these positions, 207 pips above the entry. Okay. Now on the take profits, I will only use one hard take profit. So one of the two positions will have an actual take profit target equal to 138 pips. So in the example of the pound New Zealand, I was selling at with 138 pip target. So one of those positions will be have a target 138 pips below the entry. Okay. That way, if I'm off working out at the gym, for instance, which, yeah, I admit to doing periodically, then it doesn't matter if price pops. You know how often price will pop up and then immediately retrace a lot of its move. This hard take profit will make sure that if it hits my take profit, I'm going to get my profit right there. Okay. So position one will get closed out if it hits the take profit. I keep repeating this just to stress it, but you guys can go back and watch this video again if you don't get all the rules right away. I also think we're going to be posting this slide presentation too, so you guys can get a hard copy of all these. Okay, the second position, I use a trailing stop. In MetaTrader, I use a trailing stop. MetaTrader's trailing stop is nice because it allows you to, it leaves a stop loss right where you put it until the trade is in profit by the amount of the trailing stop. So in the case of this example here, it will leave my 207 pip stop loss on this second position until price pops up to plus 138 pips. So in other words, when position one is taken out with profit at a plus 138 pips, position two's trailing stop will trigger, and the trailing stop will be 138 pips behind it, and will immediately pop this second position up to break even. So that's the automation that I really like, and I'm going to show you how to do this shortly. So that's the automation in MetaTrader that I really like, because it does not drag my trailing stop along until I've hit my initial take profit amount. All right. So what it immediately does is it pops the trailing stop up there to break even. So if I'm at the gym or asleep, or just out hanging out with friends, I don't have to worry about my trade being protected. If price unexpectedly pops up, I hit my profit, I get my profit, I lock in the second half. And then if it drops back down, I don't have to worry about the second half stopping out at the minus 207 pips or whatever, because I will be out at break even on the second half. Okay, let me show you briefly how to do that with MetaTrader. This is Pound New Zealand daily, which doesn't really matter. I went ahead and put a sell limit order up here so you can, just as an example, if you right click on the position, you can select trailing stop, and you can set the trailing stop. But I want you to notice that this is points, not pips. Whenever you have the 5-digit five decimal place price, or in the case of the yen, the 3 decimal place price, what you're looking at is points, not pips. A point is 1/10 of a pip. We usually talk in terms of pips. Okay, so 50 points is only 5 pips, and we're going to be using significantly more than that. In this case, you have to go to custom. When you go to custom, you get this window right here, and you can enter your trailing stop again in points. So in this case, I want 138 pips. So that's 1,380 points. So I have now set a trailing stop on this sell limit order. So if price were to pop up here and trigger this order, I would be short on Pound New Zealand. And I don't have any hard stops in this case, which is bad. But this is only for the example. But this would stay exactly the same until it moved down 138 pips, and then it would trigger that trailing stop and immediately pop put in a hard stop at break even. And then as price moved down, it would drag that hard stop 138 pips behind the price as it moved down. Okay. Now once it's popped to break even, that's all I use it for. I do not use this trailing stop regularly in MetaTrader, except to cover myself on these trades that I currently have open. Okay, that's all I use it for. Okay, so that's how you set that. This is the reason for the trailing stop. After the trade hits the first take profit, you want to move your stop loss to the second position, on the second position, to break even plus. Now I say break even plus because what I do is I let this trailing stop pop up and get me at break even. But what I do then is I go back to my platform, I shut off the trailing stop, and I move my stop loss to break even plus a couple of pips just to cover the cost of the trade. So if price hits the first take profit, I take 138 pips profit in the example. And then the second trade, if price just goes totally against me at that point, the second trade will close at plus 2 pips, and the plus 2 pips will cover the cost of my trade. I use a commission broker, so I pay commissions, but my spread is smaller. Okay. And the last one is I follow stops on second position as the trade progresses. Now, if you watch some of my analysis videos, and like earlier in this video, you can see where I've noticed that price was doing a certain thing on a trade. So I want to protect some of the profit that I have. So I will move the stop loss to a position where I can lock in some of my profit to protect myself if the trade goes the opposite direction. But this is where it's a little tricky because you don't want to get too close. You want to give it room to swing, but you also want to protect your profits. So there's a balance there. You have to be willing to lose a little bit to gain a lot. In other words, if the the trade may be up, let's say a trade is up 100 pips, but you've only got 20 pips locked in. You are willing to lose that 80 pips in case to give the price a chance to go another 200 pips. So that's the trade-off. The closer you put your stop, the more likely you're going to get stopped out of a good move earlier or too early, which I did on Euro New Zealand actually a few weeks ago. I got a little bit too aggressive with my trailing stop, and I got taken out of what a trade at like plus 180 pips, and then the trade is still going in my direction even now. I'm back in it on another signal, but I would have been in it I would have been up like 500 pips on this trade at this point had I left it alone in the beginning. Now, and that's part of discipline though. I mean, that's done. I don't care. It does not hurt my feelings. I don't cry in my sleep every night over that trade. It's done. There's no whining on the trading floor. I, like, 90% of the population, I follow Game of Thrones, and I loved a quote the Hound made in season 7. He was telling one of the other characters that he was whinging, and the character said, "I'm not whinging," and he said, "Your lips are moving and you're complaining. That's whinging." There's no whinging. That's just not allowed. And of course, whinging is the British version of whining. That we Yanks say whining, but it's once a trade's done, it's done. You don't worry about it. Move on. You can't cry about leaving money on the table. Okay, I didn't. Today's not about trade psychology. That's psychology right there. That's just one of my. Like I say, anybody who's been in the trade room with me knows I preach about trade psychology all the time. Okay, there is one other issue, and I thought I had a slide for it, but apparently I don't. And that is, I do, let's say that I currently have a USD CAD sell, USD CAD pair sell, and it's not locked in yet. So in other words, it hasn't hit the first take profit, and I don't have it locked in. So both positions are still open. In the case of selling the USD, US dollar, Canadian dollar, that means I am long the Canadian dollar. Just make sure everybody understands when you sell a currency pair, you are actually selling the first currency in the pair, in this case, US dollar, and you're buying the second currency in the pair, in this case, Canadian dollars. Okay. So to be short or sell the USD Canadian pair, that's the same thing as selling the US dollar and buying the Canadian dollar. Now, let's say I'm short on the USD CAD, and now let's say a really nice Canadian dollar yen, or CAD yen as I call it, buy signal happens. Now, I've already got a 2% risk on the USD Canadian trade, which is buying the Canadian dollar. So can I buy the Canadian dollar yen, the CAD yen? Unfortunately not, because I'm already risking 2% on the Canadian dollar going up. All right, I've got a 2% risk, or a 2% gamble, so to speak, that the Canadian dollar is going to go up. So if this CAD yen trade also depends on the Canadian dollar going up. So if I'm in both trades, I'm risking 4% on the Canadian dollar going up. And of course, if the Canadian dollar doesn't go up, if let's say the Canadian dollar pushes down hard, that's going to be the cause of a 4% loss. Now, on the other hand, if the signal for the CAD yen, in this case, is a sell, then I'll take it, because I'm still only risking 2% of the CAD going up, and the other trade is a 2% risk on the CAD going down, or expecting the CAD to go down. And also, once the first trade is locked in, once it's hit the first target and I've moved my stop to break even on the second half, then the risk for that trade is all taken off. So I'd be fine taking the second trade. Okay. Everybody with me on that? I know that's sometimes a little bit difficult for new traders to understand. I know you aren't all new traders, but okay. Well, we come to the question and answer portion. Zoki Master, let me read what you wrote here. Well, Zoki Master, obviously, if you can get into a huge move and you catch it right at the top, be an optimal entry, then yeah, I imagine it would fly. But the market breathes. It breathes in, it breathes out, and usually does not move with strong purpose in one direction. Okay, so that's the reason why the entry is usually not not a huge deal. So obviously, if you can get optimal entry, but what's optimal entry? You can only identify that in hindsight. So unfortunately, that doesn't help when you're actually having to try to enter the trade. SOCAR, is the dollar index going to come down? I'd have to take a look at the chart to know for sure. But yeah, I might take a look at that later on and add that to another analysis soon. I should arrange a separate webinar, but not on YouTube. Zahid, I'm sorry. You don't like YouTube? Problem is how to have a good strategy, right? Yeah, we post a lot of strategies here at Trading Strategy Guides. All those strategies are well tested and back tested, so they might be a good start. If you're a new trader and you're looking for strategies, that Trading Strategy Guides blog is a great place to look for good strategies. But testing the strategy is important for you as well, not to find out if the strategy works, but to prove to yourself that the strategy works, because your psychology and it is dependent upon your understanding and confidence in a strategy and how well a strategy works. So back testing and forward testing a strategy is very important for your mental state of mind. Okay. Oh, so Cara, I'd have to take a look at I'd have to take a look at Euro USD too. I, I haven't looked at a lot of charts this morning because I was preparing for this webinar, so I'm not sure exactly where everything is right now. Instead of break even, can I move stop loss to lock in 5? Oh, yeah. Do whatever makes you happy. I lock in +2. +5 is fine. Whatever works for your strategy. But make sure that you back test again, like I say, so you're satisfied. Back testing is not just to make sure your strategy works, it's also to give you confidence in your strategy so that you're willing to stick with it even if you go through a string of losses. Hi, Alberto. What exit strategy do you have so to avoid possible hitting the hard stop? I'll straight up, I use the Heikin Ashi candles for an exit strategy. When the Heikin Ashi changes color, I always wait for candle closes, and when the Heikin Ashi changes color, I'm out, and that usually gets me out before the before it hits my hard stop. So my favorite time frame is daily. I trade the daily charts because it doesn't take a lot of time. I can do all my setups in 20 minutes a day, and I don't have to stare at charts. I love looking at charts, okay, but I like looking at them on my terms. I stare at stock charts all the time. That's where I get these analysis videos that I do every week, because I'm always staring at stock charts and looking for things on stock charts. But it's on my terms. I'm not sitting there waiting for the chart to do a certain thing. I'm saying I'm just going through them and looking for patterns. I especially like ascending and descending triangles. They're my favorites, and they're the most. To me, they're the highest probability setup I've seen. It was strange for that ripple to break above that descending triangle. That just often is not the case. So Gar, I'm sorry to keep pushing your questions off, but the truth of the matter is I am a technical analyst, and I firmly believe that everything that we know right now is already built into the price. So even though I know that there are things fundamentally happening, and I do look at the news, and I even talk about the news in my analysis videos, but in the final analysis, I go by what the chart tells me. So yeah, obviously, whatever happens in the U.S.-China deal is going to have a huge effect on the dollar index. But sometimes, and this is the reason why I just am not real happy about fundamental analysis, is because how often do we get news that's hugely positive and then the prices go in exactly the wrong direction? For some, who knows, for whatever reason. I try to go back to find out what caused the price to move in this particular direction, and sometimes I don't find anything. Just somebody has just decided that, somebody with a huge amount of money has just decided we're going to go this way instead. So I just I look at fundamentals, and of course when there's upcoming news, I take that seriously, because upcoming news could really slam the chart. But then that's the reason why I use hard stops and hard take profits most of the time too. Zoki, yeah, I'm sure there are better than Heikin Ashi, but that's what I'm using right now. I test indicators all the time. I'm always looking for new things. Beetle, I don't have a fixed number of days that I keep my strategy. I have my take profits and my my signals, and and I just follow them completely. The difference between a triangle and a wedge, for instance, or are they the same? Well, Bill, the sometimes that's a matter of semantics. I do not, when I say this is a such and such a pattern, it's just I use terminology that I've been taught over the years in technical analysis. Um, uh, it's about market geometry, actually, and that probably would make a really good video too. But for me, no, a triangle and a wedge are not the same thing. But usually it's because a triangle is more of a regular figure, and a wedge is more of a skewed figure. So I'll get into that more in future videos. And if you watch my analysis videos, you'll see examples of all those things. I just took a trade on a descending wedge, or a bearish wedge. I can't remember what it was on. I think it was on crude oil, if I'm not mistaken. But that's the funny thing about me. I look at so many charts that I forget what I see on them. When I see the chart, I remember exactly what I thought about it when I saw it. But I often do not relate the actual picture of the chart with whatever trading instrument it was at the time. Oh, SOCAR, absolutely. Big banks, they're terrible. Yeah, they're the bane of us small retail traders. So, but the nice thing, I guess, about it is if we can stick with it, then yeah, we can we can stick with the big banks. Then we're good. Beetle, it depends on how well the chart is moving, or the instrument is moving at the time. Since my stop loss and take profit are a function of the average true range on a daily chart, then it usually doesn't take very long for one of them to get hit, unless price is just absolutely going sideways. And so, but most of my entries are about breakouts. So there are frequent times when when my target might get hit the very same day. So yeah, Bill, let me see if I find something. This is an example of a descending triangle. Okay, you've got a strong support level right here, because look, prices hit it twice, three times. It's hit it here, it's hit it here, and it's hit it a bunch of times here with huge rejection. Okay, so this is a really strong support level. This is a continually reducing highs. So this is compressing, price is compressing down into this and just banging harder and harder and harder on the support level. And then at the same time, let me move this to a new pane. That makes it a little easier to analyze. You can see, well, there's been a kind of a drop off in volume, not as much as I would normally like to see, but look at this huge volatility drop off right here. So when volume drops off and volatility drops off, what you're seeing is traders getting less and less and less interested in this consolidation. And that is the point at which the pressure starts to build to break one way or another. And typically this descending triangle will break to the downside. So I would take a close to the downside with huge volume. Well, that didn't happen, obviously. And sometimes that doesn't happen. These things are not always a thing, but I wasn't in this trade. I didn't take this trade. So I hadn't lost anything because it did the wrong thing. Okay. These are head fakes right here. And that's the reason why I like to see a close below this level. And that is when you start to see big volume come in on a close below this level. That means everybody who is bored with this movement right here is now getting interested because it's moved out of this pattern and is doing something interesting. So now people start loading on and going short with it. Okay. So that's kind of the psychology behind a descending triangle. Ascending triangle, of course, is the same in the opposite direction. Let me see. Let me look at crude. Let's see if this is the wedge. Yeah. Okay. So what happened here is price came down, and usually you got to have a nice incoming trend for a pattern to be a valid pattern. And then this increased. This went up, and it can go up in a channel or in a wedge, but it means pretty much the same thing. This is a bearish wedge right here because it's moving up, and but it's getting compressed and compressed. And again, this volume is not as significant as I would like, but look at this volatility drop off right here during the course of this pattern. So as the volatility is dropping off and the volume is dropping off, but like in this case, it's only dropping off a little. There's some drop off in the volume from, say, this peak to these peaks, but it's a minimal volume drop off. And I use this is a 20 period moving average on my volume. But this is reduced interest in this move. When it finally broke, I got short right here. This almost stopped me out. I got first profit right here. And then we got another pattern, and I'm going to show it to you on a smaller time frame because it's a little bit more obvious. Then after this breakout, we got this triangle pattern here, which I talked about in a video earlier this week, I believe. This triangle happened right here. We got this break below it, and I went short on this break below it. I believe that's where it is. I'd have to go back and look at the other chart. Oh, maybe it was right there. Hang on, let me go back and take a look at it. Yeah, no. It was this pattern right here. So I got short here. I haven't looked at this trade yet in the last day or so. I think I may be short from right here. I need to see if it's hit my stop or not. I haven't looked at it. But anyway, this is what I call a continuation triangle. Trend down, then a consolidation. Okay. So continuation triangle. And this is more of a regular equilateral triangle with equal sides and the base being right here. So, okay, those are the examples of. Let's see, Beetle, you're welcome. Stephen, right? I like pure price action, but I like indicators too. Yes, indicators lag, but you know what? The indicators show us where we've been. So that helps us have an idea of where it's going. And to be able to compare directly to each. So, Bill, good on the signals. Alberto, follow-up question: do you use Heikin Ashi as exit just when the trade has gone sour, and then keep the money management strategy? No, actually, I don't start looking at the Heikin Ashi until after I have hit first target. I do look at my entry indicators, though, and if my entry indicators start signaling the opposite direction, I will take a trade off early if it's before it hits my stop loss. but only if my entry indications say that this is going the opposite direction now. So. And I only look at Heikin Ashi for an exit when price has already hit my first target. SoCar, yeah, I use Fibos all the time. Just usually, I don't take trades off of Fibonacci's, but usually what I do is I use them to measure the seriousness of a position. Here's an example, I think. No, I guess I've already taken off this on Bitcoin here. I had measured this pop on this day right here. Let's go to that day. I'm sure everybody that trades has is familiar with this day right here where everything, or these couple of days where everything pushed up hard. So what I did was, at the time, I put a Fibo on this candle, and then later I pushed it up to this candle, because after a big move like this, and this was almost this was like $1,000 move or more, I want to see retracement, and a lot of times I want to see 50% retracement before I start thinking about a long, because like I say, the market's got to breathe, and the market often breathes after it makes a huge move like this. But look at how far I never got this 50% retracement. I got some 38s, and then price moved up to a new high, and I got some more, and price moved up to another new high. So I looked at another strategy to get into this. I ended up getting in long here at 54.42 on this candle right here. If you guys were watching my videos, you could see that, and I've talked about it. I've currently got it locked in. I don't know, up here, I think 66. I think I've locked in somewhere around here. I don't remember. But yeah, and it keeps on pushing up. So this is an example of, this thing keeps making these huge moves up. And so I'm just dragging my trailing stop up on all of these. I got my first target. This almost stopped me out right here, but I got my first target right in here somewhere. And then after this ballistic move here, which could translate into a break and go. I mean, a break and I'm drawing a blank on what it's called, but it's when your uptrend just keeps getting steeper and steeper, and it sometimes, a friend of mine used to call that puke out bars, where everybody's in the trade now, and so the smart money is starting to reverse it. And so price moves up, 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 and then all of a sudden it drops like a rock. So I've kept trying to protect myself against that. So probably later in the week, or maybe beginning of next week, depending on what this does here, I'll think about moving my stop loss up to protect a little bit more of this. So let's see. Let's see. You place order today, and tomorrow will be news of non-farm. Will you keep order of closed position? No. Usually a huge thing like non-farm payroll, I close down before that. I am not a news trader. Okay. Too much risk. Too much chance that any stop loss I put in there is going to get slipped by 50 pips. I've had that happen. It's just unpleasant. So yeah, I will shut down before huge move of huge news events. Okay. Anybody else have any questions? Oh, there's the slide I was looking for. I had them out of order. Selling USD CAD is USD sell and CAD buy. Buying CAD yen is a CAD buy and a yen sell. Both are expecting a CAD to go up. This doubles your risk. Doubling your risk is bad. Okay, you guys. Hey, stick around. We're gonna do the trading maximum. My favorite time. It looks like my slides are all out of sequence here. Oh man, I got in a hurry, I guess. These are the trade management rules. Remember them. Okay, trading maximum number 40. A loss is not a loss. It's a business expense. Think of it that way. You know, if you're in business, you know, you're going to have to buy pencils and put gas in your car and have your car repaired and fix your printer and buy printer ink, and you know, these are all, and pay for your secretary and so on. These are all business expenses. Well, when you're trading, you don't have business expenses like that, but if you think of your losses as business expense, it makes it a lot less painful. So also don't think of a loss as a mistake. A loss is not a mistake. Successful trading is based on statistics, not sure things. So always keep your trade size small, and if a loss happens, it's no big deal. It's just the cost of doing business. Okay. There you go. If you got a day job, don't have time to analyze charts and stuff, which can be time consuming. TSG has got the Strike Trader Elite Trade Signals service. Took me a lot of practice to get all that out in one breath. It's Forex trade signals on a dozen or so pairs on different time frames, and they're all based on the Strike Trader Elite system, which I've done a video on. I'll put a link to that below. Also, there'll be a link for free signals. There are free signals on this. They use the Telegraph application, which is really nice. I commend Casey and his team on finding this Telegraph app. It's so much better than the other tools that we've been using for signals. Okay, let me see if I got any new questions here. Beetle, I use trailing stop to protect myself in case price goes wacko, which yes, it does periodically. And I use the Heikin Ashi because it gives me an early signal to a reversal. And it's not always right, but no indicator is always right. But it gives me an early signal. So I don't, so if price is actually reversing, Heikin Ashi might give me an early signal that it's happening. And the trailing stop is really there just to protect my profits in case price goes wacko. Okay, you're welcome, Beetle. Alka. Again, I hope I'm pronouncing everyone's names right. I apologize if not. Yeah, actually, I probably should do a recap. Casey wants me to put them in a book, an ebook, so I'll probably be doing that. The bad thing about Strike Trader Elite is that 95% of the signals are 15-minute. Yeah, that's obviously because the shorter the time frame, the more signals you end up getting. Please tell the team to help us get H4 and D1. That would be great. Very cool. I'll let them know. Bill, Renko is interesting, but I haven't really messed with it a lot. So that's a good question, and I really like the idea of Renko, and I should spend some more time. PSAR is awesome. I've used that a lot for exits and trailing stops and all sorts of things. So cool, Beetle. All right, you guys, please hit the subscribe button below. We love you. Hit the thumbs up too, so you get notification when we have videos come out. We do this webinar every Wednesday at 9 a.m. New York time. That's the plan. Okay. I put out an analysis video on Monday and Friday. I try to get them out early, but sometimes they come out late. It just depends on how slack I am. Actually, what it depends on is how long it takes me to find something worthy of doing technical analysis on. But my trades are really on target. Not all of them. Not all of them. There have been some. The pound dollar was a loser. But that happens. Like I say, not everything is perfect. There are no 100% winners. And if they tell you they are a 100% winner, they either haven't been trading very long or they're lying to you. So, so there is that. All right, you guys, thanks for listening. Thanks for listening to me drone on for over an hour today. You guys have a great remainder of your week, and I will see you next time. Zoki Master. Yeah, absolutely. Just I think info@tradingstrategyguides.com. Yes, I'll post the position calculator link and some other stuff down below. All right, you guys, have a great day.